Hello friends, welcome to our channel Wealth Affairs. Please subscribe to our channel and ring the bell once to remain updated about all fantastic videos we share for your enrichment. Keep learning, it will give you the best return, someone has very rightly said. Today we will learn about one investment instrument named Sovereign Gold Bond. Remain with us till the end to know about all the nitty-gritties of the bond. Before the detail, let us have a glance of historical price of gold for last 50 years. Here we have plotted the price of 10 grams of gold since 1970. If we look at the gold price in 1985, it was 2130 rupees per 10 gram, and in 2005 it reached up to 7000 rupees per 10 gram. So approximately 3.5 times in 20 years. But post 2005, it climbed up very sharply. The biggest reason was the global financial crisis in 2008. Any uncertainty in the economic scenario in the international market sends the gold prices up. Same thing happened during the COVID crisis, and gold prices reached 50,000 mark in July 2020. Our objective here is not to predict the gold price, but to have an idea about its journey. Let us see how we can invest in gold. The most traditional way is physical gold, ornaments, bars, coins, where we buy gold from any jeweler or any dealer and store it for future. Then came the gold ETF, where we invest in gold in digital form through Demat or mutual fund platform. It's convenient to transact and store. And finally, the latest way to invest in gold is sovereign gold bond. Let us see the details of it. It is issued by RBI at current market rate. Generally, it is open every month for around 5 days and called as series. Price for every series is fixed. Even if the price moves up or down during the issue, the cost of the investment remains the same. 1 unit of sovereign gold bond is 1 gram of gold and can be bought in multiples of unit. The total tenure of the bond is 8 years and there is a lock-in of 5 years. This means you cannot liquidate the bond from RBI in first 5 years, and after 8 years the bond will automatically redeemed at the rate of gold price at that time. Now, one of the important features of this bond, the investor get interest of 2.5% per annum on the initial investment. So one investing 100 grams today at the rate of rupees 5000 per gram will have to invest rupees 5 lakh today and will keep on getting rupees 12,500 for next 8 years, that is rupees 12,500 every year. This interest income is taxable as per the income tax slab of the investor. Then comes another fantastic feature of sovereign gold bond, that is the capital gain is tax free, which is you won't have to pay any income tax on the profit. Suppose you invest rupees 5 lakh today and get back rupees 9 lakh after 8 years, so 4 lakh is profit, but you need not to pay any income tax on this 4 lakh rupees of profit. Demat account is optional here. If you want to sell it in secondary market, it has to be in Demat account. Else, you can invest without Demat as well. Sovereign gold bond can be used as collateral for taking loans from any bank or financial institutions. No GST or security transaction tax is applicable here. So the entire money you invest is allotted for the bond. You also can avail a discount of 50 rupees per gram if you wish to invest it digitally, like from your net banking or mobile banking platform. Not all the entities are eligible to invest into sovereign gold bond. Only individuals, HUF, trust, universities and charitable institutions are allowed to invest in sovereign gold bond. There are some specified upper limits of investment in one financial years. Individuals and HUFs can invest maximum up to 4 kgs and trusts and others can invest up to 20 kgs in one financial year. Nomination facility is available for individual investors and it is highly recommended as it is for a significant investment horizon. Let us see the comparative study of different ways of investing into gold. The first is the impurity risk. In case of physical investment of gold, there is impurity risk, whereas in case of ETF or sovereign gold bond, there is no impurity risk because these are held in digital platform. In case of making or storage cost, yes, in case of physical investment, there is a making or storage cost, because if you are investing into ornaments, there is a making cost, or even if you need to store it in a proper place, so there is a storing cost as well. Whereas in case of ETF and sovereign gold bond, there is no such cost which is involved. Now this is a very important differentiator, which is capital gain tax. In case of physical investment and ETF, both are taxable, whereas sovereign gold bond is capital gain tax free. That is, we need not to pay any tax on the profit portion. The interest income, there is no interest income which is available in case of physical or in case of ETF investment, but here we get 2.5% per annum of interest income in case of sovereign gold bond. There is GST which is applicable in case of physical investment, but in case of ETF and sovereign gold bond, there is no GST or security transaction tax which is applicable. In case of safety or default risk, yes, in case of physical investment, there are some amount of safety risk always involved into that. In case of ETF, there is no safety risk, but yes, some amount of default risk is always there, as it is issued by some financial institutions. And in case of SGB, there is no such risk because it is issued by RBI. And finally, the ease of transaction. The investment in physical gold is not very easy. You have to go to some place to buy it, you have to store it, and again take it to some place to sell it. But in case of ETF and sovereign gold bond, you can very well do it digitally without any hassles of physical purchase. Thanks for watching the video. Please share it with your friends and subscribe to this channel.